the guys that keep lifting the call options off the market makers force the market makers to buy more stock in order to remain delta neutral. And so that's really what's happening.
What ends gamma squeeze? What ends gamma squeeze is what he said. Stocks begin to come in, right? Because what feeds a gamma squeeze is this persistent call buying that forces market makers to run out there, hedge their positions by buying more stock.
Hi, and welcome to Your Finance TV. We've had a healthy second quarter in US equities so far, and the bears seem to be lowering their heads. Let's focus on the quality of the rally though, being heavily led by mega cap tech names with a handful as the prime suspects. What's next? I'm joined today by Jeffrey Hughes, founder of Alpha Insights, and Jim Strugger, managing partner at Kineo. But before we dive into the show, don't forget to like and subscribe to Your Finance TV so you can stay on top of the topical videos. Jeff, Jim, welcome.
Thanks, man.
Great to be here, Mehdi, as always.
So we're kind of in this weird little market now. And Jeff, we obviously did our Alpha Insights videos every week, and we've been talking about Skew Index and how it's been diverging from the VIX Index recently. You've mentioned that the Skew Index has been making new highs, while the VIX Index has been making new lows. You've also suggested that you expect them to converge at some point. I have two questions for you. What do you think caused this divergence, and what factors do you think could make them converge again? So, Jeff, without further ado, over to you, sir.
Yeah, it's a tough question, but I think the real answer resides kind of in the combination of $11 trillion in passive mutual fund assets and 0 days to expiration options. I think that, with option open interest at new all-time record highs, and you've got this kind of one-sided overcrowded long position, it's created a bit of a self-reinforcing feedback loop that's artificially distorting risk indicators and suppressing volatility. And it's something like a gamma squeeze right now, a la GameStop a couple of years ago. It's the big stocks keep going up, and the guys that keep lifting the call options off the market makers force the market makers to buy more stock in order to remain delta neutral. And so that's really what's happening. And I think with that, it's forced the skew to misrepresent the level of or really illustrate the level of risk that's in the market, while the VIX currently underestimates the level of risk in the market.
And what do you see is going to change that?
I think a big correction. I think what we're looking at is, a peak in a bear market rally it's terminating right now. And I think as institutions recognize that the valuations don't reflect the fundamentals in these, magnificent seven stocks that have been leading the averages higher, they're going to begin to sell. And one of the drivers of that, I think, will be the Russell rebalancing into mid-year here, as well as kind of the mid-year and quarter-end rebalancing that we're going to see a lot of major institutions undergo. In fact, JP Morgan penned an article recently estimating that this rebalancing could result in kind of the net sale of $150 billion in equity assets from pension funds, sovereign wealth funds, Swiss National Bank, Japanese Postal Service. All of these major long-term asset allocators are now super overweight U.S. equities because of the boom in AI/EV technologies, which have come off the lows of last October and carried up well over 100% in many cases, taking the NASDAQ up over 60%. And so that rebalancing is going to have a big impact on the major averages, and I think that could be that could catch the street off guard and force that the alligator jaws to snap shut, if you will.
Those darn alligator jaws. Jim, Jeff and I get to chat every week on Alpha Insight show about stocks, but this is the first time you and I are having the pleasure. So thank you for joining us. And
thanks for having me on.
This is obviously your wheelhouse, the whole options activity that's tied to the Skew Index and such. I'd love to hear your thoughts on this.
Sure. Well, maybe we could start just quickly walking through what skew is and why it matters and why Jeff has it in his analysis. It's something that option traders have looked at since the beginning of time. It certainly has picked up more eyeballs over the last few years as option volumes have skyrocketed. When I ran an institutional derivative desk just a few years ago, daily option volume was about half of what it is today. Right now, we trade something like 42 million contracts a day. And frankly, it was sort of 16, 17 just 5 years ago. So when Jeff talks about gamma squeezes and he talks about skew and he uses other phrases that reference the listed option market, there are just many more people who are interested in these topics and frankly interested also in using them to exploit their understanding of the market and ideally increase their capital at play. But what skew is a measure of implied volatility in a single expiration across moneyness or different strikes. So if you have at the money here, you've got puts over here and calls over here, typically what you have is puts are going to be richer in terms of implied volatility, tends to be up here, and it's referred to as a volatility smile. Usually option geeks refer to the crash of 87 as the impetus to embed that in the market. And it's simply explained by the fact that investors want and need insurance. So they're willing to pay up for downside protection in puts versus calls. Now, in skew, there are a few interesting phenomena. One is the Skew Index, which really measures very far out of the money implied volatility of options or measurement of skew, right? So you're talking about a tail index that the SIBO has created here. And so when it's very high, as it is right now, that representation is of investor concern of some sort of tail event, something that happens way out on the distribution, usually to the downside, right? And so that's what people are talking about when they look at this skew index. It's a critical point too, though, because there is not a single measure of skew. In the SIBO's case, that's the skew index, but there are other measures of skew that look at this implied volatility curve across a single expiration in time and attempt to make sense of it. But at the end of the day, with where the skew index is right now, it is historically high, and it absolutely seems to have had this enormous divergence with spot VIX, which at 13 and change now is its lowest it's been in several years. So I'm certainly on board with Jeff in terms of the reality that once a correction begins, what you should see is the skew index decline fairly sharply and for VIX to move up. And in my work, one element of VIX that I would add to all of this is we think about the long-term cyclicality of VIX. If you step back and you look at VIX data since inception in the early 1990s, there have been several distinct periods of high and low volatility. And these periods tend to last 5.5, 6 years. As we measure it to COVID, we're just about 3 years. So in our thinking at our firm, there still could and should be several more years of elevated volatility. So the fact that we're down at 13 is an enormous curiosity to us. If it were to continue lower from here, break through 12 and have its eyes on 11 and 10 and 9 and 8 and levels that we've seen in prior years, that would be alarming in a volatility sense. It would be wonderful for equity markets. But from a volatility perspective, that would break this pattern of these long-term cycles that we've looked at now for 20 plus years. So that would be very interesting. But frankly, I would align with Jeffrey that skew tells us that people are hedging their tails. VIX tells us, I think, that we're right around a cyclical trough and that we can very likely and should very likely move up from here and potentially see actual shocks in the coming months as the macro plays out. And I think that's really where we align with Jeff and his thinking in terms of these jaws snapping shut.
Is it fair to say that for these jaws to shut, it would be almost a black swan event that would kind of lead to that catalyst?
I don't think so. I don't think so. In fact, I would think that spot VIX could probably get to 18, 19, maybe even 20 with a relatively small correction in equities. A move above there, once you get spot VIX above 20, and then a potential inversion of the VIX futures curve, and then we get into sort of a potential shock, that would be a different story. I don't think we necessarily need a black swan. I think we just need stocks to weaken a little bit. I mean, it's been a remarkable rally from, if you want to say October of last year or January of this year for the Qs. It's basically been straight up. And one other point I would make as it relates to that is Jeff referenced gamma squeeze. Right? So once this incredibly aggressive call buying slows down in single names at the index level, et cetera, then that sort of breaks this virtuous cycle of these gamma squeezes. And that's what I think eventually the impetus will be. A name like Tesla begins to decline. NVIDIA begins to decline a little bit. Those enormous call buyers take a breather. And then we're back into a market where you don't have this gamma squeeze phenomena at work. We'll see it again in the future, because unless all these listed option market participants dissipate and go away, they will be back. They'll be back in size. And the reality is, we now know that they can trade enough volume in listed options to have really an enormous impact on individual stocks and indices.
I don't think they're going anywhere, Jim. Jeff, did you want to add anything to that?
Well, only that, VIX just printed a 40-month low today, and it happens to be VIX expiration, if I'm not mistaken, right? And so I think this implies kind of a new extreme in investor complacency. We're seeing it, converge with very, very high readings in a number of different measures, be it the AAII survey of individual investors, which is now seeing a bull-bear spread of over 22%, up 60 percentage points from its lows last October. We saw the CNN Fear Greed Index hit 82 for a few days in a row. We saw the DSI, which is the Daily Sentiment Index from tradefutures.com that measures individual traders' positioning and sentiment relative to their futures positions. And in the NASDAQ, that got up to 93, which was the highest we saw it since late November of 2021, when the NASDAQ market topped. So all these things together kind of converging in this, ebullient degree of sentiment that, the bulls are now embracing again. And it seems to me that whenever, it gets to this level, everybody's all in. There's nobody left to buy, and things just get a little bit, overdone. I mean, I was watching Bloomberg the other day, and I rarely do, as I mentioned, and the people talking seemed very giddy. They were laughing and giggling about the market and where it was. I mean, you just don't see this level of giddiness in the market under normal circumstances. So, I think all of this is just effectively pricing risk at the end of the day. And, anything that is out of the ordinary could trigger kind of a domino effect where, you start to see, selling just quickly cascade into a market plunge. And, as you and I have talked many times, we've got a bigger picture view on the market that sees things unwinding from here and moving lower. And our view is that we go to new lows. And I don't know if it's a black swan event or if it's just nothing that happens, like in 2018, where there was no event. Things just got overdone and there were nobody left to buy. And suddenly you had a 20% correction out of the blue, right? And so that can happen too. And that's basically what I think the Skew Index is telling you, is that the probability of something like this has moved up from around 2% to 15% now. And if the odds were 15% that the plane you just boarded wasn't going to land safely in Orlando on your trip to Disney World, you'd take a bus or a train or you'd drive. You just wouldn't get on that plane. So the odds are not in your favor at this point, is what I'm saying.
Well, I was just about to wrap with asking both of you, are these things making your spidey sense and the hairs on the back of your neck kind of pop up a little bit? But Jeff, I think you've certainly expressed your opinion on that side. I'm not taking a flight to Orlando at 15% downside. So, Jim, do you have any spidey sense concerns?
Yeah, I do. Although I would honestly say that I've had them for a little while. So VIX, to me, at this level is disconcerting, because I don't think that we're in a world where it can continue steadily lower to 8 or 9 and be back into a low volatility regime. So yeah, my spidey sense is certainly going off. And then I would just add one other factor to Jeff's long list of extremes, and that is that in some individual names, Tesla, NVIDIA, you actually have inverted skew. So investors are paying more in implied volatility terms for calls than puts. Now, I don't want to say that's not supposed to happen in equity markets, but as we discussed earlier, the risk bias in equities is typically to the downside. In commodities, for example, it's just the opposite, where if there is a supply-demand imbalance, then the risk is to the upside, and you see this sort of inverted skew where investors would pay for calls over puts. It's not very usual in equity markets, and we have that now. So that's another one you could add to the list of this sort of extreme behavior where investors demonstrate that they believe they're bulletproof. And none of us are probably young enough to not have been through a number of shocks in financial markets. I know I've been at it since 1996. In my first few weeks, there was the Thai baht devaluation and the Russian debt default in early 1998. So I've sort of lived by these shocks, and I'm sure both of you guys have as well. And I don't want to say we're due, but again, our underlying view is that we're in this high volatility regime. We're troughing in that high volatility regime, and time will tell. If spot VIX continues lower, then that will sort of be the antithesis of our view. But ultimately, in a time like this where markets act the way they have over the last few days, I think it's healthy for everyone to have a little bit of spidey sense and prepare for not what's inevitable, but what could play out in realistic financial markets over the coming months.
Well, with the new Spider-Man movie out at the moment, I guess everyone's spidey sense should be going crazy. So, on that note, gentlemen, I really want to thank you for your time. And I think we should be doing a recap at some point over the next couple of weeks just to see where your thoughts are again as well. But thank you for sharing your thoughts. And before we go, Jeff, where can people subscribe to Alpha Insights?
Yeah, well, there's two places. You could go to my website, which is jwhinvestment.com, and you can see our institutional research there. And we also publish a monthly newsletter called Huge Insights, The Big Picture, and that can be found on Substack at hugeinsights.substack.com.
Fantastic. And Jim, where can people go to learn more about Kineo Capital?
You can just go to our website, kineocapital.com, and there's information on there if anyone would like to reach out. But we're always around and always in markets.
Nice and simple. Thank you again, guys. And thank you for watching, and good luck investing.